The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker. I'm Hong Bin Jung. Now, global markets are navigating a storm of uncertainty driven by renewed geopolitical tensions, shifting interest rate expectations, and the looming prospect of tariff-heavy policies under a potential second Trump administration. Traditionally, reliable safe havens like the US dollar and treasuries are losing their aura of stability, prompting investors to question long-held assumptions about where and how to allocate capital. In this environment, the very concept of long-term investing is being put to the test. Is the old playbook still relevant, or is it time for a fundamental rethink of investment strategies? Can investors still rely on time in the market, or must they adapt to a new reality where volatility is the norm rather than the exception? Well, to find out more, joining me now is Ivan Neo, who's a wealth manager at Phillip Capital. Ivan, welcome to the show.
Hi, thanks for having me here. It's a pleasure to be with you.
Thank you so much for joining us. Ivan, how would you describe the current market situation at the moment?
Right, so right now we are in the middle of a 90-day US-China tariff truce, which is set to expire on July. So that's already brought some relief to the markets, with tariff on both sides scaled down dramatically. But with a lasting deal, whether it will be reached by the July 8 deadline, we are still uncertain, but we are hoping to get there. Moving to Asia, a weaker US dollar is driving strong inflows towards Asia, especially into Taiwan and emerging ASEAN markets. So this is also supported by excitement around AI. For globally, growth is slowing but not stalling. The IMF still expects 3.3% growth this year, and inflation data in the US is cooling. So consumer price index, which reflects the cost of goods and services purchased by households, is now at 2.3%. And producer price index even declined last month. So that opens the door for a potential rate cut later in the year if inflation stays in check and tariff doesn't spike again. So markets have been quite volatile this year. The S&P 500 is roughly flat for the year after a 15% drawdown, but sentiment still remains cautiously optimistic. So investors should keep an eye on data. They should stay diversified and focus on resilience. So that means looking at quality large caps, defensive sectors like healthcare and utilities, and income-generating assets like bonds, especially if growth softens. So we can expect more benefits on the upsides for fixed income and treasuries compared to stocks if tariff situations break down or economic sectors show pessimism. But at the end of the day, I think volatility, as you said, is the new normal. But with tech breakthroughs and smart positionings, investors can ride the waves rather than get tossed around by them.
So given the current geopolitical and economic uncertainties, does long-term investing still make sense for the average investor today, Ivan?
Yeah, so long-term investing still absolutely makes sense for the average investors, just like how we approach investing in our own personal lives, for example, our health, our personal growth, or our career. So a long-term view helps guide better decisions that we make today. So it keeps us from reacting emotionally to short-term noise and helps us stay focused through market swings. So if we take the recent US-China tariff situation, for example, so while the headlines may feel alarming, I believe it's more of a negotiating tactic to attract investments into US and gain leverage rather than a permanent trade blockade. So another example of volatility which trends towards stability was on April 9. So right after a social media post from the US president encouraging people to invest in the stock market, we saw a 90-day pause on nearly all tariffs just 4 hours later after the post, and the S&P 500 surged 9.5%. So we are living in a more volatile times where tariffs, interest rates, and geopolitics are keeping market on the edge, and that's the new normal for now. But what matters most is staying focused, investing with a long-term plan, and understanding that countries ultimately want to grow their economies, not sabotage them. So resilience and discipline, I think, are what will carry investors through.
Is there a shift within investors when it comes to long-term strategies then? Are investors no longer holding long-term investments?
I think we are seeing a shift in investor behavior, but it's not a move away from long-term strategies. So today's investors are still focused on goals like retirement, wealth preservation, and legacy planning. But what's changed is how they approach these goals. So people are becoming more tactical, adjusting allocations based on shorter-term developments while keeping the long-term plan in place. So also technology has played a big role in this. So with more access to market information and easy to use platforms, investors today are far more informed and independent. And we are seeing the rise of hybrid strategies as well, where long-term call holdings like exchange-traded funds or blue-chip stocks are combined with more active positions in trending sectors like AI, energy or technology, or in Asian ex-China markets. So the low or zero commission environment also encourages more frequent investing. Investors are rebalancing more often and thinking strategically and not just doing a once a year rebalancing. So I think the long-term mindset is still alive and still active. It's just evolved. It's more flexible, more active, and people are more informed than ever before.
Okay. Well, on that note, seeing all of volatility in markets, does the current market behavior reflect a short-term panic or a structural shift in investor mindset?
I think it's more of a structural shift than just short-term panic. So while bouts of panic selling do happen during major news events, the broader pattern of investing behavior points to a deeper long-term transformation in how people approach investing. So with what has been happening in the last 5 years, investors have probably come to accept more volatility, whether in the form of shorter economic cycle, black swan events like COVID and geopolitical, economic and financial conditions that can change rapidly with new governments. So the demand of liquidity and flexibility has grown. Investors are now placing greater value on liquidity and the ability to pivot quickly.
Okay.
So this trend,
Well, then what are some of the biggest misconceptions investors have about long-term strategies in today's volatile environment?
I think firstly, the biggest misconception is it pays to be reactionary or too reactionary. So historical data shows that missing just a few of the best performing days will impact long-term returns. So consistency and discipline in investing often outperform reactionary strategies. So we try to avoid trying to time the market. And while we should pivot and embrace new long-term trends, investors often perform badly by reacting to short-term shocks as they tend to sell low and buy high. Also, long-term doesn't necessarily mean not doing anything. So many investors assume that once they adopt a long-term strategy, they can simply set it up and forget it. So just like we need to adapt our lifestyle to our life stages, successful long-term investing requires regular portfolio reviews and rebalancing with changing market conditions or personal life circumstances.
Are there specific asset classes or regions that still align well with long-term investment goals despite market uncertainty then?
Okay, so high-quality equities still remain foundational. Companies with strong fundamentals, consistent earnings, and pricing power, especially in sectors like healthcare, consumer staples, and technology, they continue to align well with long-term goals. Dividend-paying stocks as well. They can offer steady returns and a buffer during downturns. Also, we have fixed income. I think fixed income is regaining its role in portfolios. So with interest rates stabilizing at higher levels, I think investment-grade bonds and high-quality sovereign debt are becoming attractive again. They provide capital preservation, income, and a counterbalance to equity market volatility.
So with safe havens like the US dollar and US Treasuries also facing growing skepticism at the moment, where can investors turn for stability?
I think diversified fixed income remains relevant. So while US Treasuries face headwinds, and in fact, they just got a downgrade on the Moody's rating by one notch. So other segments of the bond market, such as the high-grade corporate bonds, short duration instruments, and inflation-linked bonds, they offer relatively stable yields and lower volatility, making them viable alternatives for risk-averse investors. Then we also have defensive equities offering quality and resilience. So sectors like healthcare, especially with the emerging weight loss drugs and the aging population, utilities with AI infrastructure set to double in the US by 50% by next year, and the driving trend in cloud servers and data centers, as well as consumer staples. They tend to perform well in uncertain environments due to their steady demand. So companies with strong balance sheet and consistent dividend payouts, dividend companies also provide a degree of stability amidst market swings.
Okay. Well, Ivan, when we think about long-term investing, one of the strategies we often think about is the 60-40 portfolio model. So should the 60-40 portfolio model still be considered a benchmark for long-term investing at the moment? Does that model still work?
Okay, so the 60-40 portfolio model, 60% equities, 40% bonds, it has long been a foundational strategy for balanced investing, historically delivered solid, well risk-adjusted returns. But in today's world, it's also important to recognize that the landscape has shifted. So with persistently high inflation, elevated interest rates, and greater market volatility, so we saw the limitation of this model, especially in 2022, where both stocks and bonds fell at the same time. So that's because the assumption that bonds will always offset equity risk may no longer hold true.
Right.
So correlation between asset classes has shifted. So a more risk tolerance investor, for example, might opt for a smaller bond mix and reallocate the rest into safer investments like treasuries.
I see. Well, when it comes to investing, especially for young investors who are just starting out, a lot of people say, have a long time horizon, look for the long term. So what advice would you give to younger investors who are just starting out at the moment? Should they still adopt a long-term view?
Yeah, definitely adopt a long-term view because I think what I mentioned earlier, investing shouldn't be that different from our lives, right? So having a long-term goal, having a long-term view helps us to make better short-term decisions and also helps us to react more emotionally.
Right.
So if instead of thinking for younger investors especially, instead of thinking of investment as something to be good in really quickly or a one-time decision, I think we can think of it as cultivating a habit as well. And the journey is a long-term journey.
Right, journey is a long-term journey. But how should more risk-adverse investors adapt their long-term strategies without, overreacting to short-term noise, especially in the current market conditions?
Right. I think the first thing is understanding the nature of the short-term noise or the risk. So not all risks are avoidable. For example, inflation risks, they are just part of life and part of the economy today. So while we can't prevent it, we can plan for it by building buffers and adjusting our expectations. And I think we can try to stay objective and not react emotionally to market noise. So sensational headlines and panic-driven selling often does more harm than good. So in fact, some of the biggest long-term gains tend to appear during the worst market dips, right when investors are most tempted to pull out. So having clear long-term financial goals help us to stay grounded and make rational decisions even in volatile times.
Well, on that note, before we let you go here, Ivan, are there any early indicators or metrics that you believe investors should closely monitor in 2025 to help guide long-term positioning?
Right. So I think the current economic condition now is really quite dependent on data and headlines. So headlines and news from the tariff situation, geopolitical tensions and wars, and looking at long-term global trends such as the emergence of technology and AI to understand how the world is shaping. Then we can look at data points such as inflation trends and central bank signals, as the current market environment is, I mentioned, quite heavily data dependent. Then we can also look at earning growth and forward guidance from companies. Look at what companies are saying, what they're investing in, and also look at what governments are investing in.
Great. Well, thank you so much, Ivan, for your time and your insights today.
Thank you.
Thank you. That was Ivan New, who's a wealth manager at Phillip Capital. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.